Hi, hello, and welcome to Learn Stroke IAS classes. And we are discussing the budget analysis for 2024, and this is the part 2 video. In the previous video, we have already discussed about the various schemes, various aspects of the budget. In this, we'll discuss about the income and expenditure of the budget, or you can call it as a part B, and we'll discuss the receipts or revenue of and the expenditure that is incurred by the government, and this will help you understand the budget with a much more clarity. Okay, so we'll go through, and in the meanwhile, please do subscribe to our channel, LearnStroke IAS classes, and do download the LearnStroke IAS app to watch the classes and follow our offline institution of Future Next IAS. Okay, so let's quickly move on to the sessions, and first of all, let's know the basics of revenue and expenditure, because it's very simple to know that even from a family level. Well, look at it from a very micro level. Imagine that a family has got an income of 100 rupees. Just imagine 100 rupees. And the family is having an expenditure of 170 rupees. So what happens is there is a deficit of 70 rupees. You only have a budget of 100 and you have a expenditure of 170. So 70 rupees that has gone beyond the budget. So what will you do to get this 70 rupees? You can actually borrow the money. Sometimes you can borrow the money, or you can take a loan. So this is very normal for every family, every business, and it is also very common for the government also, because we as a nation is a very, very big country. So definitely we have a lot of responsibility to fulfill. So definitely we have this. These are the scenarios when we say that we have deficit. And there are various ways of funding the deficit, like deficit financing, which is the basic theory. So I just wanted to give you an idea, basics on expenditure. So we'll also understand how the government is making money and how the government is spending. Okay, so let's get some basics here correctly. What is the concept of total receipts and total expenditure? It is very, very important to know, because you will see this term total receipts and total expenditure. So total receipts means it is the sum of all revenues collected by the government in a fiscal year. So it is the sum of all revenues. All revenues means it can be tax revenue, it can be non-tax revenue. So all the revenue that government is making is the total receipts. And total expenditure, the sum of all spending by the government. So whatever thing the government is spending, whether it be capital expenditure or revenue expenditure, whatever government spends is this. And on top of this, there is something else called as the borrowing also, which we should have an idea, because how much government is also borrowing. So knowing the idea of total receipts and total expenditure is very, very important to know about the budget. And let's have an idea again. This is the basic tax revenue. What are the tax revenue? This is the tax revenue, the primary source of receipts, because they are the receipts, like they are the taxes collected from the individuals, corporations, sales, property, and other forms of taxes. So these are the basic taxes, which is called as the tax revenue. And number second, we have a receipts called as non-tax revenue, which is not coming from the taxes. It is coming from something else. Like you can see, earnings from the government on corporations. So how much money the corporations are making us, and services, fees, fines, licenses, or any other income from government services and activity that are not tax related. So you can see all the income that the government is receiving apart from the taxes. It is the non-tax revenue. So this is just to get a basics. I'm just telling you all this. So tax revenue, non-tax revenue. Similarly, you can see these were the revenue receipts. These were the revenue receipts of the tax revenue, non-tax revenue. What are the capital receipts? See, unlike regular income or funds that the government, this is the income that the government raises or receives that are not part of its regular income stream. So the government raises or receives. This can include loans, very important capital receipts. You can include loans from domestic, foreign sources, proceeds from the sales of an assets. You sell off something, you get that money, and repayments of loans by state government or local government. So this is the money that you get. Please remember, the government, it's not part of the regular income. Loans from domestic and international, proceeds from a sale of an asset, repayment of loans by state or local government. So these are all the capital receipts. And have a look at the expenditure also, because we need to have an idea about the capital expenditure and revenue expenditure. So know about the revenue expenditure. The word itself means revenue. Receipts mean revenue. Expenditure covers all spending. It contains all spending that does not result in the creation of assets or reduction in liabilities. It is not reducing a liability, nor it is creating any asset. But these kind of expenditure is important, like salaries of government employee. It does not create an assets or limits. It is not reducing a liability. Subsidies that the government give, interest payments on debt. We pay interest on the loans that we have taken, and expenses on services provided by the government like healthcare and education. Revenue expenditure are recurrent in nature, meaning they occur regularly and are necessary for the day-to-day function. So this is the revenue expenditure. And moving on, let's understand the capital expenditure. The capital expenditure is aimed at creating assets. So this one creates assets or reduces our liability. Very important. It includes, like, basically all these are investments in infrastructure like roads, schools, hospitals, which the government should definitely create. A purchase of land, a machinery, equipment, and also loans provided by the government to state or other entities that are expected to be repaid. The government is giving that. Capital expenditure are typically one-time investments and have a long-term impact. So this is also clearly understood. The capital investments create a long-term impact on the economy. So this is the basic. So I hope you know what is the difference between a tax receipt, non-tax receipts, revenue receipts, capital receipts, and revenue expenditure, capital expenditure. I think this is clear. And now let's look at the budget. What are the important keywords? And I'll tell you the meaning of that. Okay, let's see. The budget talks about something called a revised estimate. So what is the revised estimate is the first thing. What is the concept of this revised estimate? Simple. Revised estimate is a crucial figure in budgetary process, and it is reflecting adjustments made to initial budget predictions based on actual financial performance through the financial. So this is the estimate. It is reflecting the adjustments made to initial budget predictions based on actual financial performance. So keywords, it is actually an adjustment which is made to initial budget predictions. Initially there was a budget prediction that this will happen, this will happen. This is an adjustment to the initial budget prediction based on actual performance. So it's not only an adjustment, it's based on the actual performance. You say that time you predicted that this is going to happen, and taking into account the present financial performance, you do an adjustment, and that is the revised estimates. So in this budget also we are going to have a revised estimates in this. So let's understand the number 1.1. The revised estimate of the total receipts other than borrowing. So borrowings are not included. Other than borrowing is 27.56 lakh crore, of which the tax receipts are almost 23.2 lakh crores. The revised estimates of the total expenditure is 44.9. This is just a revised expenditure. Okay, this is the adjustment based on the financial performance, and this is just a revised estimate. So what is the total receipts? You can see that the total receipts, and it is included minus, it is minus borrowings. You can see it is minus borrowing. It is not calculated how much money you've got. Minus borrowing is 27 lakh crores. Very, very important. 27.56 lakhs crore. And out of this, tax receipts. So definitely total revenue receipts means you can definitely add tax receipts, tax revenue. You can add the tax revenue or plus the non-tax revenue. So this is out of this. This is what is called the total receipts. So tax revenue plus non-tax revenue, and this is saying that the tax revenue is 23.2.4. So it is saying that 23.24 crores is the part of that. So just imagine. So what is the non-tax revenue? You can simply calculate it. 27.5 minus 23.24 is the non-tax revenue. So let's have an analysis. What is the main points telling? This means the total income expected by the government from sources other than the borrowing. So borrowing is already cut. Other than the borrowing is 27.56 lakh crore. Out of this, 23 lakh crore is anticipated to come from taxes. This is a simple statement. So this includes both direct taxes like income tax, corporate tax, and indirect taxes like goods and service tax, customs duties, etc. So out of this 23.24 lakhs is going to crores is going to come from? So the difference between the total receipts is 27.56 and the tax receipts are 23.24. When you subtract it, you will get a new figure. 4.32 is expected to come from the non-tax receipts. So this is the non-tax receipts that we are supposed to get it. So what is the non-tax receipts? Like it is earnings from public sector enterprise, fees, fines, dividends, profits, and other non-tax sources of income. So this is one thing. So we can understand that the tax revenue, this is just the budget estimate. This is the estimate. So according to the estimate also, we believe that, just imagine that how much tax revenue we are supposed to get in. How much tax revenue we are supposed to get in, and it is almost 23 lakhs crores is tax revenue. Just 4.32 crores is non-tax revenue. So just imagine how much money government is getting through the tax revenue. So non-tax is very small. That is very clear. This is the budget estimate. And let's look at the second point also. The revenue receipts at 30.03 lakh crores are expected to be higher than the budget estimate, reflecting strong growth momentum in the economy. So the revenue receipts at 30.03, that was a revenue budget estimate. Always it's actually an estimate, adjusted, taking into consideration the financial performance based on the previous budget also. So the revenue receipts at 30.3 lakh is expected to be much higher than the budget estimate. So budget estimate we already know, but the revenue receipts are much more bigger than that. So let's understand what does this statement mean. When it is stated that the revenue receipts is 30.3 lakh crore, it indicates that the government anticipates its income from revenue sources like taxes and non-tax revenue to surpass the initial budget projections. So just imagine that the budget projection is X. This time you believe that it has actually increased. It has increased from the initial budget projections. So 30.3 lakhs revenue receipts means tax plus non-tax revenue. It's very clear. And moving on, the third statement. Revised estimate of the fiscal deficit is 5.8% of GDP, improving on the budget estimate, now notwithstanding moderation in the nominal growth estimate. So you can say that the fiscal deficit is 5.8% of the GDP. So again, you should understand what is this concept of fiscal deficit. So please remember, try to imagine the example that I gave you. You have 100 rupees revenue and you have 170 rupees expenditure. So definitely there is in your house also there is a deficit of 70. Okay, so definitely remember the deficit concept. And now understand what the statement says. What is fiscal deficit? Fiscal deficit is the difference between what? The total expenditure of the government and its total revenue excluding borrowings. That is the point. Total expenditure minus total revenue excluding borrowing. So fiscal deficit of 5.8% of GDP means that the government spending exceeds its revenue. So this is exceeds its revenue by an amount equal to 5.8% of the country's GDP. So just imagine the loss that we imagine. So just like we say that say 4% is actually 4% of GDP is almost out of 100, just imagine that 4% of the GDP is almost invested for defense. See, I'm just giving you examples. Okay, just imagine that you are spending it for defense. A country is spending 4% of its GDP out of 100 for defense, and it is spending almost 3.6% or 3.9% for the infrastructure out of GDP. We say that 4% is actually went for defense and 3.6% is already went for infrastructure. So already it is 7.6% so out of 100. So we say that this is how we calculate. And imagine that a country is spending close to 6% of this GDP for education. So defense is 4, education is 6, 10 plus 3.6, infrastructure is 13.6. So we can clearly come to the conclusion that within 13.6% of the GDP of the country is spent on education, defense and infrastructure. Likewise, we can say that when you say that 5 point is the fiscal deficit of the GDP means, just imagine 5.8% of the GDP is fiscal deficit. That means That is the difference we have. That is the deficit we have in this country. So obviously, when 5.8 increases to 10.8, what will happen? The deficit is too high. That means we will not be able to spend much on education or other important sectors. We will not be able to fund it. When the deficit increases, we will not be able to fund it. Just imagine imagine that a country is having 20.8% deficit, means it's huge expenditure and there is no revenue coming to the government. That means crucial investment in various sectors of the government is missing. So ultimately, what is our task is we should always reduce the fiscal deficit. How much we can reduce the deficit, that much amount of money we can use it for other sectors also. So I think this point is also very clearly taken. So 5.8% of the, it's equal to the 5.8% of the country's GDP for a given fiscal year. So the fact that 5.8% is an improvement of the budget estimate suggests that the government anticipated a higher fiscal deficit, but 5.8 is normal. But is it good? We need to do more fiscal deficit calculation also. In the budget speech of 21-22, the target was to reduce fiscal deficit below 4.5 by 25-26. And the fiscal deficit in 24-25 is expected to be 5.1% of GDP. So we need to improve also. 5.8, we need to bring it down to 5.1 and even below 4.5. So when you keep increasing, when you reduce the budget to 1, fiscal deficit to 1, definitely there is no deficit at all. We'll be in a very positive situation. So understand that concept. The next fourth one is coming to 2023-24. The total receipts, I know you know what is a total receipts, other than borrowing and total expenditure is 47.6 lakh crores. So the total receipts is 30.8 lakh crores and the total expenditure is 47. So this is the total revenue. Total revenue is 30.8 lakh crores and the total expenditure, the TE, is 47. This is total revenue is it's not including the borrowing, so you can cut down the borrowing. The borrowing is not included in this. So this is what we have to understand here. The borrowings are not included in this. So let's have an idea on this. And the tax receipts are estimated at 26. So out of this, so the government is really believing that the government expects to collect 30.3 lakh from the sources other than borrowing. So borrowing is again cut. This includes all revenue through taxes, both direct and indirect, and non-tax revenues like fees, fines, royalties, etc. So 30.8 is excluding. This is what the government believes. And let's look at the total receipts, 26.2 lakh crore. This amounts to a significant portion of the total importance of tax. So it covers it's going to be tax receipts. So out of this total 26, out of this 30, just imagine out of this 30, 26 is going to come from the tax revenue itself. So obviously you can easily calculate what is the non-tax revenue from this, which is very important. The government plans to spend 46.66 lakhs crore. So this is encompassed in all planned projects, including development projects, defense, subsidy, interest payments on debt, salaries of government employees, and social welfare programs. So this is also important of how expenditure income is important. And let's move on to the next important thing. The next point, again, what we said is, so you can just calculate this difference. 30.8 is the revenue. You can just 30.8 is definitely the income that we are getting, and 47.66 is the expenditure. So what is the deficit? You can clearly calculate the deficit. In this case, the fiscal deficit would amount to 47.66 crore exceeds 30.8 lakh crore. So definitely this gap, there is a gap out of this. How can we do this? This is deficit financing reflects the government's need to borrow money to meet its expenditure. So this is very clear. When you understand this, 30.8 minus this will give you the deficit, and how can we fund that gap? Definitely there should be deficits also. Deficit financing needs to be done. Okay, now move on to the fifth important analysis. The scheme of 50-year interest-free loan for capital expenditure to states will continue this year. What is this? 50-year interest-free loan for capital expenditure of states will continue this year with a total of 1.3 lakh crores we are going to invest on this. So let's understand what does this statement mean. The concept of a 50-year interest-free loan for capital expenditure to states is a fiscal policy tool. So 50-year interest-free loan is a capital expenditure tool used by the central governments to support the state's investment in long-term assets. Very, very important. It is actually given for states investments for a long-term assets and infrastructure projects without burdening them with additional interest. Definitely, states also want to create, develop. They need money. So now, without putting lot of interest on them, we can give them 50-year interest-free loan so that they can also develop the states. States will also have better infrastructure. This is to stimulate the economic growth, enhance infrastructure development, and improve public services at the state level. So this 50-year interest-free loans, please understand, their capital expenditure, central government to support states investment and long-term assets and infrastructure projects. So definitely it's a good thing for the states also. And let's see the sixth important one, the gross and net marketing. So there are two important words here, the gross and net. The gross and net market borrowings through dated securities during 2024 is estimated to be 14.13 and 11.75 lakh crores. Both will be less than 23. So you can see the gross is 14.13 and the net market borrowings is 11.75. And they believe that both will be less than 23. So this time it is going to be less. So you need to understand what is this market borrowing, what is this gross, and what is this net. Well, let's find out what is this gross. This simply refers to the total amount of money, or the money government plans to borrow from the market. The government is planning to borrow it from the market. Of how? They will issue dated securities like government bonds. So government is going to sell this bond or put out this bonds, and it is going to borrow money from the market by giving dated securities like bonds. So during the fiscal year 2024-25, let's understand that 14.13 lakh crore. So also understand that dated securities are long-term debt instruments that government uses to finance the deficit. So definitely government wants to borrow. So they are going to dated securities are used. So dated securities are long-term instruments which governments uses to finance. So you have a funding problem. You are issuing what? You are issuing government bonds and you are borrowing the money from the market. This is what is simply called as market borrowing. And let's see the net and gross. Let's calculate the gross first. The gross borrowing refers to the total amount of funds borrowed by the government over a specific period of time within a fiscal year. So the first is total amount you borrow within a year without accounting repayments. So that is, you can cut off with, you don't account repayments, you don't calculate redemptions during that period. It is the sum of all borrowings and debt instruments which issued by the government. Definitely. So it is a sum of all borrowings and debt instruments. So please understand, gross borrowing means total amount of fund borrowed by the government within a year, not calculating repayments and redemptions during that period. All the money that is borrowed either through debt or something. And let's calculate the concept of net. The net borrowings are calculated by subtracting the total repayments. You should subtract, very important, you should subtract the total repayments of past loans. See how much money is being repaid from the gross borrowing. So already we have a gross. So from this gross, you have to minus whatever you have paid for the repayment of past loans. Then you will get the net market borrowings. So in this case, it is 11.7 lakh crores. So this you can understand. So this is the net, the gross minus the total repayment. So you can take a look at this. 14.13 is the gross. When you calculate the past repayments and all other things, you can see that the net market borrowings is 11.75 crore is the net. And according to the estimates, the previous budget is much more lesser than that. So the government is not borrowing much. So it's it a good thing or bad thing? I hope you must be understanding it right now. So this is the concept of this. So both gross and net market borrowing for 2024 are expected to be less than those from the previous year. This indicates a reduction in the government's reliance on market borrowings to finance its deficit. So very important, this is what we have to understand. This shows that the government is not borrowing from the market to finance its deficit problem. This is what we have to understand from this statement. Next is moving on to the seventh one. Over the last 10 years, the direct tax collections have more than trebled, and the return filers swelled to 2.4 times. So that means tax collections have been better is one thing, and the people who file the returns are also increased. So let's understand what does this statement mean. This means that the amount of money collected by the government through direct taxes, like directly paid to the individual, directly paid by the government by the individuals and corporations such as income tax, corporate tax, has increased more than 3 times. Very important. So you can understand that it has increased, trebled. It has trebled. So the direct tax amount the people pay, the taxation has increased 3 times. That's an important point. The number of individuals and entities filing tax returns has increased to 2.4 times. That means people who are filing the taxes also increase. So what does this show? This show that more and more people and corporations are declaring their income and taxes accordingly. So most of the people are paying taxes. It's a good thing for a country. People are paying taxes. People are responsible people. So that is the understanding. And the next statement, take statement number 8. The government has reduced and rationalized taxation. Under the new tax scheme, there is no tax liability for taxpayers with an income of 7 lakhs, up from 2.2 lakh in the financial year. So what does that mean? You don't have to be taxed until your income is less than 7 years, and this has increased. This has become better. How? Let's see. See, government has undertaken reforms to reform the income tax structure, and you can see in 2013. Individuals with an annual income of 2.2 lakhs were not required to pay any income tax. So in 2013, if your income was about 2.2 lakhs, you were supposed to pay tax. So this has significantly increased. Now they have made it to 2.2 to 7 lakhs. If your income is less than 7, you don't have to pay a tax. If it is more than 7, you have to go for it. So that is the clean understanding of this statement. And let's look at the 9th one. The threshold for presumptive taxation for retail businesses was increased from 2 crore to 3 crore. Presumptive taxation for 2 crore to 3 crore. Similarly, the threshold for professionals eligible for presumptive taxation was increased from 50 to 75 lakhs. So we have to understand what is this concept of presumptive taxation. We are talking about the presumptive taxation. In one, it is actually given for retail business, and second, it is given for presumptive taxation. What is something that we have to look at here? Let's clearly understand. Presumptive taxation. Let's clearly understand. It's a simplified tax system. It's actually given for small taxpayers to ease the burden of detailed bookkeeping and tax filing. So when you are a small taxpayer, what is the biggest difficulty? The biggest difficulty is bookkeeping and tax filing. It can become complicated at times. So if you're a small taxpayer, instead of calculating tax based on actual income, say you have earned say 1 crore rupees. Imagine that you have got 1 crore rupees. Just calculating the 1 crore rupees and how much tax you have to pay, we are not following the system. Let's not follow that how much money you're going to pay. It's not the actual income that you take. Let's imagine that taxpayers can declare their income as a fixed percentage of the total turnover or receipts. This is presumptive taxation. So let's not, instead of calculating tax based on actual income, let's cut actual income, not actual income. You can declare the income as a fixed percentage of your total turnover or receipt. So imagine that you have a turnover of this. You can say that, say, imagine there is a turnover, say 1 crore turnover is there. You can fix a certain percentage of this turnover as your declared tax. You presume it. That is it, presumptive taxation. You presume this taxation, reducing the time and effort needed to comply with the tax laws. It is particularly beneficial for small businesses and professionals, making tax compliance straightforward. And so this is actually helping the small taxpayer. It is not the money, you earmark certain percentage. So this is presumptive taxation. Now let's understand what the statement says. The statement clearly said it's reduction of it's increase from 2 crore to 3 crore. So let's understand what does the statement mean. The threshold limit for retail businesses to be eligible for presumptive taxation has increased from 2 crores to 3 crores. This has increased. This means that retail business with a turnover up to 3 crore can now opt for presumptive taxation. Very simple. Previously, with 2 crores income, you could have opted for presumptive taxation. Now, with 3 crore money, you're also eligible for 3 crore to opt for presumptive taxation, calculating the taxable income as a fixed percentage of their turnover, without the need to maintain the detailed financial record. So definitely for small retailers, it's going to be a good thing. You have increased the statement, even in the bracket of 3 crore, you can actually claim this presumptive taxation. And similarly, the threshold for the professionals has also increased, like doctors, lawyers, engineers, architects, accountants. Eligible for presumptive taxation was actually previously they were actually for 50 lakh, and that has increased to 75 lakhs. That means they can also assume a fixed percentage of their gross receipts as taxable income without detailing the expenses. So this is what presumptive taxation simply means. Okay, moving on. The corporate tax rate was decreased from 30% to 22% for existing companies, and to 15% for certain new manufacturing companies. So it is coming down to 30 to 22, and some of the companies it is just 15. So corporate tax is actually decreased. So let's understand what do you mean by corporate tax. Corporate tax, also known as corporation tax or company tax, is a direct tax. It's a direct tax imposed on the income or profit of the corporations and other business entities by the government. So it is actually taxed on your income or profit. The rate at which corporate tax is applied varies from various country to country, and it is different. So this is corporate tax, that the income that you get. So decreasing it from 30% to 22%, this means that domestic companies which were previously taxed at 30% on the profits now will be taxed at a lower rate of 22%. So the companies can also make a lot of money on that. So this reduction in the tax rate leaves companies with a higher portion of their earnings to reinvest in their operations. So previously they were paying 30%, and now 22% means definitely 8% is saved. The companies are saving 8%. This 8% which they should have given tax, they are getting that money in hand. They can reinvest in their operations, distribute it to shareholders, or use for expansion. So this is more attractive for the business. So you can use the excess money. Tax is actually decreased. And it was reduced to 15% for new domestic companies engaged in manufacturing. The special rate applied to companies that meet specific criteria like primary. This significantly lower tax rate is intended to spur up industrial growth, attract domestic and foreign investment in the manufacturing sector, and create more jobs. So definitely for countries, it has decreased to 15%. So this will definitely help the companies to park. They don't have to pay that much tax. They can use that tax money to pump in expansion and create more growth, is what is actually meant by the statement. And now is the age-old jurisdiction based on assessment system was transformed with the introduction of faceless assessment and appeal, thereby imparting greater efficiency, transparency. So previously, according to the tax, you can see that there was something called as the jurisdiction based assessment. So how do you assess? Imagine that the tax system, there was a jurisdiction based, and now it is faceless assessment. This is faceless assessment. Previously it was jurisdiction, and now we are going to faceless. Let's understand what does this statement mean. The introduction of faceless assessment and appeal system in tax administration mark a very significant shift from traditional jurisdiction based assessment system. So imagine that the faceless system minimizes physical interaction between the taxpayer. So this is X is the taxpayer, and you are the taxpayer. You are the taxpayer. X is the tax official. So previously there was a usual interface. The tax official clearly know who is the taxpayer. This is you. The tax officials clearly know that you are the person. They know the jurisdiction. And what has happened is the faceless system minimized physical interaction. So there is no physical interaction right now here. The physical interaction is deleted. It's actually minimized. The physical interaction between taxpayers and tax officials are minimized. So what does this mean? This means that there is no bias. There is no scope of larger corruption. So this is a good thing. And assessments, reviews, and appeals are handled through a centralized digital platform, speeding up the decision making and reducing the time and resources spent on task disputes. So, by removing the direct face to face interaction between taxpayers and tax officials, the system aims to reduce the potential for bias or corruption. That is the important thing that we have to remember here. It ensures that all decisions are made through based on the data and information provided through a centralized platform. So it is actually faceless are good because you can cut down the corruption. And the shift from a jurisdiction based assessment system to a faceless means tax assessments and appeals are no longer handled by local tax officers based on the geographical location of the taxpayer. Imagine that you are from this place. It is not handled by the local offices. It is actually a centralized system. The centralized platform will be handling that. So that is the key important thing that you have to understand here. And also there is another thing, a new form of 26 IAS and pre-filing of tax returns have 26 made filing of tax returns simpler and easier. Average processing time of returns has been reduced from 93 days in the year 2013 to 14 days. So this is actually relating to the refunds. A new form, 26 IAS and pre-filing of tax returns have made 26 made filing of taxes returns simpler and easier. So the average, so previously 26 IAS, the tax filing date was 93 days in the year 2013. 14 to a mere 10 days this year. So this has actually from 93 days, it has actually come to 10 days this year, making the refunds faster. So this is one thing that you have to know. And know the most important points of GST. It is also talking about the most important points of GST here. What is the point of GST? Definitely by unifying in highly fragmented indirect taxation regime, GST has reduced the complaints burden on trade and industry. So that is a point that is noted in the budget. So 94% of industry leaders view transition to GST as positive. So 94% of the people believe that GST is a positive thing. According to 80% of the respondents, it has led to supply chain optimization as an elimination of tax arbitrage. So according to the GST, it believe that it has led to supply chain optimization. GST has led to supply chain optimization. It has elimination of tax arbitrage and octroi, and has resulted in disbanding of checks posts at state and city borders. So definitely these are the advantages of GST that we have to know. Tax base of GST more than doubled, and average monthly GST collection has doubled. So this is that we noticed in the previous classes. Tax base of GST has doubled, and the average monthly collection of GST has also doubled, which is a good thing. People are paying taxes, something that we can understand at this point. And we'll look at the next point. The state's SGST compensation, the state GST revenue, including the compensation released to states in the post-GST period of 2017-18, has achieved a buoyancy of 1.22. What do you mean by the statement? What do you mean by the statement? States GST revenue, including compensation released to states, has achieved a buoyancy of 1.22. So you need to know what is the concept of buoyancy. Let's quickly understand what is the concept of buoyancy, and you will understand that what is tax buoyancy. Tax buoyancy is a measure of how well the government tax revenues keep pace with the economy. See how well government tax revenue is keeping pace with the economy. So imagine that the buoyancy of more than one indicates that tax revenues are growing at a faster rate than economy. So imagine there are two components. One is the tax revenue, and the other side the growth of the economy. You can see that it is how the economy is growing. So that means tax buoyancy is how well it is growing, keeping in pace with the economy's growth. And the buoyancy of one indicates that the revenue is growing much more better than the economy. If it is less than one, that means the tax revenues are growing slower than the economy. So I hope you understood this concept. And one means it's growing more than the economy. Tax revenue is more than the economy, growing more than the economy. If it is less than one, tax revenue is growing less than the economy. Is something that we have to understand at this point. Okay, so this is one important thing that we have to understand here. And let's move on to the next important concept, and let's see what else we have to see. So the term buoyancy in the context of tax revenue refers to the responsiveness of tax revenue growth in relation to the growth in the tax base, typically measured as GDP or GNI, gross national income. So I think you understood this. I've explained what do you mean by this concept of one. Let's quickly so look at the statement. The tax buoyancy of 1.22 in the context of states goods and service tax, including compensation related to states, indicates that the state GST revenue has grown at a rate that is 22% faster than the growth of underlying tax base or the state of economy. So 1.22 means this buoyancy means simply means the state has 1.22 buoyancy means the state's revenue or the state's revenue growth rate or the state's revenue has grown 122% faster than the growth of economy. State's economy, just like I said, if it is above 1, it has grown much more than the economy. If it is less than that, it is growing slower than the economy. So state's revenue is 22% faster growing than the state's economy. This is what we have to understand simply from this statement. So let's find out what are the other important points that we have to understand in this. So you can see a buoyancy figure of 1.22 is above unity, which means revenues have grown at a faster rate than the economy. This is generally seen as a positive indicator. So definitely a positive indicator is something that we have seen here. So I think let's understand the next important 14th point. So next is understand this concept of 14th point, which is clearly saying the tax buoyancy of state revenues from subsumed taxes in the pre-GST 4-year period to 2016 was mere 0.72. In contrast of the tax buoyancy of the state's revenue from subsumed taxes in pre-GST 4-year period from 2013 12 to 15 was mere 0.72. So what is this concept of subsumed taxes? Let's calculate this. Let's understand this. The term subsumed taxes refers to those taxes that were replaced or consolidated into a new tax system. In the case, the goods and service tax was implemented in 2017. When the GST came in, the previous tax were replaced. So you can see before GST, states levied various taxes such as value added tax or VAT, sales tax, luxury tax, and entertainment tax. So the buoyancy figures pertains to these similar taxes. So let's look at this. It say that the tax buoyancy of states revenue from subsumed taxes was mere 0.72%. Let's understand the statement again. So 0.72 for state revenues from subsumed taxes in the period implies that the growth rate of state tax revenues was lower than the growth rate of the economy. This is very clear. I told you what is tax buoyancy. 0.72 means it's less than 1. If it is more than 1, the state tax revenue would have grown more than the economy. But it has come down 1. That means if it is coming down 1, that means the tax growth of state tax is slower. It's lower and slower than the growth rate of economy. So for every 1% growth in the economy, tax revenues from these subsumed taxes will be grow only 0.72%. It's simple terms. Tax revenue did not keep pace with the economic growth. Very, very simple point. So I hope you understood what is tax buoyancy. It did not keep up with the economy. So always remember there is one thing, the growth of the tax and the growth of the economy. So if it is more than 1, tax is increasing more than the economy. If it is less than 1, tax is decreasing with the economy. It's a very simple point. And a buoyancy of less than 1 signifies tax system as less responsive to the economic growth. So I've given this topic. And the 15th one, let's understand outstanding direct tax demands that are considered petty, non-verified and non-reconciled or disputed. So what is this concept of outstanding direct tax demands? What is this concept of outstanding direct tax demands is something that we have to understand. Let's understand what is outstanding tax demand. See, these are amounts that tax authorities claim taxpayers owe in terms of direct taxes. So you are a person X. These taxes, outstanding tax demands means this is something that you have to pay into the tax department. These are the amounts that the tax authority claims that you owe to the tax people. Now, direct taxes are taxes paid directly to the government by the individual or organization whom it is imposed, like income tax, corporate tax, etc. When these taxes are not paid fully according to the assessment by tax authority, it results in tax demand. So imagine that you are this person and there is a tax demand. Tax is demanded by the office. You have an income tax or anything. Say, imagine that your tax is 100 rupees and you only feel that you have given the tax of, say, you have only paid about 80. So 20 is something that you have not paid. You are supposed to pay that extra tax, but you did not pay the original tax. So when these taxes are not paid fully, the assessment by tax authorities, it results in tax demands. This is simply what is meant by the outstanding direct tax demand. This is the outstanding direct tax demand. And what is a non-verified tax demand? Non-verified tax demands are those that are not been conclusively verified or validated by the tax authorities. So they have not conclusively verified or not validated. So these are non-verified taxes. Disputed tax demands are those that taxpayers has formally contested. You say I have 100 rupees to pay. I say I have only 80 rupees to pay. I'll not pay the rest of the 20 rupees. That is disputed. I'm not going to pay it. 20 rupees I am not going to pay. That means you have a dispute. This can arise from disagreements over the interpretation of tax laws, valuation of the taxable income, or applicability of the deductions or calculation of the tax. So these you can dispute this. This is dispute tax. Disputed tax demand, non-verified tax demand, and you can see the direct tax demand of direct tax demand. So the government is planning to withdraw outstanding direct tax demands that are considered very petty. So this is a good decision. The government is saying that we will not take petty, non-verified, non-reconciled or disputed tax amount. These are small amounts of money that the government claim taxpayers owe, but due to their nature, resolving these demands can be very complex and not at all cost efficient. So government is wasting a lot of money for this non-cost effective thing. So both for taxpayers and the government. So we say we are withdrawing this for petty, non-verified and reconciled and disputed tax. So this is actually setting out thresholds for the withdrawal of these demands based on the amount. So let's calculate what is that amount. Demands up to 25,000 for the period up to 2009-10. We are saying we don't want this. Up to 25,000. And demands up to 10,000 rupees for financial year 2010-11 to 2014. We are ready to say we don't want it. So these are the important things. And the 16th one, definitely, as the budget says, the finance minister says, I'm not proposing making any changes related to the taxation and propose to retain the same tax rates for direct taxes and indirect taxes, including import duties. So import duties also, they are not making any major changes. And certain tax benefits to startups and investments made by sovereign wealth or pension funds, also tax exemptions on certain income of certain IFSC units are expiring on 31/3/24. So to provide continuity in taxation, I propose to extend the date to 31/3/2025. So startups investments made by sovereign wealth or pension funds, there was a tax exemption which was supposed to expire. This is even increased by 1 year. We increase that date for you. So these are some of the most important points that we have to discuss in this income and expenditure analysis. I hope it was easy to understand this. So please do subscribe to our channel, Learn Stroke IAS classes, and do follow our offline venture, Future Next IAS. So we'll come up for another session. So thank you so much.